In this video, I'm going to show you how to record sales returns and allowances in both the perpetual and the periodic inventory systems. But before I do that, I want to mention that I believe something great is going to happen for you today. And now back to the video. If you're someone who is not quite sure the difference between the perpetual versus periodic inventory method, go ahead and give this video a thumbs up. That way I'll know that you need more videos to help keep it straight in your head. Thank you. All right, I've been doing a series on the perpetual versus periodic inventory methods, and I am doing the second part of it now where we're looking at the sales side of it. You can take a look at the first video though in the series, and I've linked it up here for you. So we did a video last time in which we journalized the sale of merchandise to a customer on account. In other words, the customer did not pay cash for it. It's an account receivable. And now in this section, the customer returned merchandise with a sales price of $150 and which originally cost the company $90. The merchandise was not defective, was returned to inventory to be available to sell to another customer. Let's look at how that transaction would be recorded in the perpetual inventory method. First, we're going to book the return. So we have a debit to an account called Sales, Returns, and Allowances. Don't confuse it with the account that was Purchase, Returns, and Allowances. That is when the company returns an item to their supplier. This Sales, Returns, and Allowances is for when the company's customer returns the item to the company. We know that the company sold the item that's being returned to the customer for $150. In other words, that was the price on the price tag that the customer paid. So we're going to debit that $150. We also need to reduce the customer's accounts receivable in which they owe us money. They owe us that $150. We need to take that off the amount they owe us because they have returned that portion of the merchandise. So we're going to credit accounts receivable, which we know is an asset account. So it's going to be reduced by credits, and we're going to reduce it by that full $150. Next, we need to put the item back into inventory, both physically and on the books. So we're going to debit inventory, but we don't want to debit it for the sale price because that's the amount that we are selling it to customers. We want to debit the cost, what our cost was, how much we paid or our company paid to our supplier. And we're told in this that it was $90. So we're going to debit inventory for $90. If we were to use the $150 amount, we would be overstating our inventory, and we don't want to do that. And now we're going to credit our cost of goods sold. If you recall, in the sale transaction, we had debited our cost of goods sold for the inventory price, and now we're going to credit it for that same $90, and so our transactions balance. You have now properly accounted for the return of merchandise under the perpetual inventory method. Now, let's look at the periodic inventory method with the exact same facts. The customer is returning the item which cost $150, so we need to debit sales, returns, and allowances for the full $150 that it was sold to the customer for. And we're going to credit accounts receivable for that same $150. This part of the transaction is exactly the same as under the perpetual inventory method. However, at this point, we do not debit inventory. This is where it's different from the perpetual inventory method. We are not going to debit inventory at this time. We're going to be, even though we physically put it into the inventory, as you recall, in the periodic inventory method, we don't calculate cost of goods sold until an inventory is actually taken, when we actually count the inventory. So you have now properly accounted for the return of an item under the periodic inventory method. If you like this type of content and would like more, I recommend that you go to my website, askprofessorcapko.com, and sign up for my free email newsletter, which will keep you up to date on various things that I find helpful. There's also things you can do listed down in the description of this video that will help you out, and you can also do to support this channel. You should also, now that you know some of the information about perpetual versus periodic inventory, there's more to know. So make sure you subscribe to this channel and click that notification bell so you never miss a video. Thank you.